Bristol Myers Squibb, the stock has been beaten up over the last 2 months. We'll give you our thoughts on it in this video. You'll learn about the financials, their pipeline, where they're heading. We'll show you our software and how to look at the numbers. If you're looking to trade Bristol Myers at a quicker pace, you can join Mo and he'll show you all the charts and trends so you can take advantage of these ups and downs. But first, why should you watch this video? I bring your questions about this pharmaceutical company to a couple guys who own and operate over $100 million in real estate, multiple businesses upstairs, and stocks, and they'll show you a mindset about how we should approach investing in a pharmaceutical company like this. This stock is down a ton. You'll learn about it now. Paul, what are your thoughts on this company?
Thank you, Uncle Seth. First off, follow us on Instagram, Everything Money Investing. It's our new Instagram account. It's probably the best Instagram account to ever exist. Second only to my Instagram account. You can follow Seth, Mo, and I on Instagram as well. Please do it because my ego is so delicate. It's like a delicate flower. So this is our Everything Money exclusive software. We're going to the 8 pillars tool. We're going to pick up Bristol, Myers, Squibb, and Sons.
BMY.
Okay. So first thing we're going to do on Bristol Myers Squibb, we're going to look at the max chart. What do we have here, Sethy? What do we have here? In 2000, look where the stock was. What is that, 75, 80 bucks?
We love looking these up.
And what is it today?
Yeah, boy.
What is the stock price today?
58, 54 bucks.
So guys, if I told you in 2000, the height of the tech boom, the height of technology and pharmaceuticals, after seeing this stock go up like this, and I'd said to you, hey, 21 years from now, that stock's going to be lower than this today. All you lemmings out there would have telling me, no, you don't get it, Paul. This is the future. Medicine's the future. Look how much better medicine will be 20 years from now. It's so much better than it was 20 years ago. And then you would be giving me your excuses today as to why this happened. Oh, well, this and this happened. But how many, if you watch our videos over and over, so many companies have this exact chart.
Yeah, Paul, you always say, it's hilarious because if I would have told you, it's like, folks, we're actually telling you in every video about every company that like you have to be careful out there. And by the way, Paul, there are no stock splits here. This is all true.
Well, yeah, this would, even if there were stock splits, it would all show it on here.
Go on.
And that's the thing is companies like Tesla, which I think will be valued way lower in the next 10 or 20 years than it is today. But either way, I digress. We have the 8-pillar analysis. Let's start with number 1. Well, first off, it's a $120 billion company. Pillar number 1, we want the 5-year PE under 22.5. It's 102.
A little smart.
That's an X. They lost $5 billion last year, by the way, kids. Pillar number 2, pharmaceutical companies tend to have a high return on invested capital. We want their 5-year return on invested capital greater than 9%. It is 9.2%. That's a check mark there. Now, one thing I'll make note, last year's net income shows a loss of $5.4 billion, but last year's free cash flow shows $14.5 billion positive. So what this tells me is they did a massive write-off. Okay, now this is part of the things I want you guys to learn by watching our videos. I immediately sat there and said, looks like a massive write-off. Keep in mind, I've done zero research on this company ahead of time. I've not looked at the financials, I've done nothing. I just come here and I talk to you because the financials are what drives my decisions about looking further into a company. So, they have a nice little dividend here. 3.6%, almost triple the market. It pays out $4.3 billion a year. Now, for those of you out there who are new, dividends are not always secure. You have to compare the dividends to the free cash flow. So your Uncle Paul, in this exclusive Everything Money software, puts the free cash flow right above it for that reason. 4.3, the average 5 year is 8.6, last year was 14.5. They can easily afford this dividend. About half the money in the last 5 years has gone towards this dividend. They repeated this over and over. So they're safe on the dividend. Pillar number 3, we're going to go to the income statement in our exclusive software, and we're looking for 5-year revenue growth. 19 billion to 45 billion. Massive check mark. What do I think happened here? Anybody want to answer that?
Everybody got sick?
Sethy said everybody got sick. Mo, what do you think? They had to have made an acquisition.
They made an acquisition.
19 to 20 to 24 to 38 to 45.
Yeah, they've made 2 massive acquisitions in the last 3 years.
All right, so let's see if I'm right, and let's see if Mo's right.
You're right.
We're going to skip quickly to the cash flow statement, and you're going to go to the acquisition section of the investing area. Oh, and look at this. $10 billion, $13 billion acquisition. The negatives mean they spent money. Mm-hmm. So that's driving their revenue growth. Now, what do they acquire? Mo will look into it right now, I'm sure.
The last acquisition was a company called Myocardia.
Oh.
Yeah.
Okay.
And they acquired Celgene.
Oh, Celgene, that's right, because they wanted to be... Mo, tell them what the name was going to be for Celgene.
Oh, it was going to be Bristol Myers Squibb Celgene
And Associates.
and Associates JD.
Esquire,
MD.
LLC.
LLC.
Okay, pillar number 4. We want net income growth over the last 5 years. 4.23 billion to a negative 5.4. That's an X. Now remember, guys, there's some write-off here, right? Other income and expenses, $7 billion negative. Yep, that's their big write-off there, guys. And another $10 billion special income charges. So they've written off like $17 billion worth of stuff.
Jeez.
That's exciting. Who likes that? Okay, next. We want to look at their shares outstanding. Pillar number 5.
Yep, thanks, Paul.
We want shares outstanding decreasing. Now, they made a lot of acquisitions. My guess is they probably use shares to do that. But the reason being is when companies are issuing more shares, they're diluting you as an owner. They are decreasing your ownership and your share of the revenue and profit every year. If a company has 100 shares, you own 10 of them, you own 10% of the business. If they issue 50 more shares, going to 150, you still own your 10 shares. You got nothing extra for that. And now you're splitting your money amongst 150 other shares. So now instead of owning 10% of the business, you own 6.5%. It sucks. So shares outstanding, go to the bottom, 1.64 to 2.22. That's an X. However, this is the big jump when they made these acquisitions. All right, so I'm not going to make a comment on the acquisitions were good or bad, but they issued shares to make the acquisition, so it's not quite the same.
Pillar number 6 involves their debt. Paul, walk us through pillar number 6.
So guys, we go back to the metrics page on our exclusive software. We go to the 5-year average free cash flow. Look how easy it is all in our software. 8.6 billion. We multiply it by 5. That is $42.4 billion. We want their long-term liabilities to be under $42.4 billion. So we scroll up to the top of our exclusive software. We go to the balance sheet. We scroll all the way to the bottom. Total liabilities, long-term liabilities, $52 billion. So that's an X, guys. They have a lot of debt. Okay, pillar number 7 and 8 have to do with cash flow. We love free cash flow. Seth, what is free cash flow?
Yes, so free cash flow is your cash from operations minus your capital expenditures. And with this, you can do one of 5 things, which I'll most certainly forget. You can pay dividends, you can buy back shares, you can pay for acquisitions, you can reinvest in yourself, and you can pay down debt.
Yes.
Wow, look at me flossing now. Look at me now.
Look at me now.
I'm getting papers. Go ahead.
So, guys, I've made it very easy in our exclusive software. Cash from operations less your capital expenditures. I personally added this line to the software. And the reason being is the math can get confusing. But just wait. We also have another pillar on the software that you'll see. 4.43 billion 5 years ago to 14.57. That's a check mark. Remember, they had 2 big acquisitions, and you see those big jumps in acquisitions. Next thing is you take our final pillar, you take the 5-year average free cash flow, and we're multiplying it by 20. 8.6 times 20 is $172 billion. So we want the market cap.
Yeah, the actual market cap, Paul, is 120 bill.
Wow. And the other thing is, Seth, this 8.6 billion didn't include the previous acquisitions.
Would you be shocked to know that there's 50 phase 3 compounds in their pipeline?
So what's the most important thing? First off, let's go to the 8 pillars tab, because it does all the math for you right here.
Go ahead.
Now remember, they made an acquisition here on shares outstanding, not as worried about it. I'm not worried about this because they had 17 billion or whatever in write-offs. I like this. Now remember, guys, it's all about the growth. And we're going to make every investment the present value of all future cash flows. For pharmaceutical companies, what matters? The pipeline matters. Seth just said they have 50 companies in their phase 3. Is this accurate?
I mean, I'm looking at the list.
It's not surprising. They're one of the biggest companies in the world, the drug companies in the world.
I think the number is like 55 or 60% of phase 3 drugs get approved. So right then and there. Now, granted, the question is, are they marketable drugs that can generate a lot of revenue?
They do a lot of research, and there's a lot of drugs that are not going to be massive revenue drivers. So is it great that the drugs are getting out there? Yeah, but how many of those are going to be massive revenue drivers?
I would assume making all these costs a lot of money, increasing their debt, Paul. I mean, you're going to go in the hole a lot to finally find something that works, then you publish it and make money on it, right?
Well, you can use the free cash flow as part of your part of that free cash flow. Investing back in yourself is R&D.
I see, of course.
Right? Yep. You don't have to take on debt to do that. Their debt was taken on.
And they get a lot of government grants for that stuff too. So
what was that?
They get a lot of grants too.
Oh, do they?
Yep.
Okay, so their long-term liabilities going back to it jumped up big time. Yeah. So look, when they made those acquisitions, they took on a lot of debt too. 29 billion, 29 billion, 60 billion. That was between 19 and the third quarter and fourth quarter of 19. They made massive jumps in their debt.
I see. Do you want to show us the stock analyzer tool?
Yeah, so let's look at the stock analyzer tool. Now, guys, like we say, the stock analyzer tool, every investment's the present value of our future cash flows. We made the stock analyzer tool so that you could make your assumptions about the future, because we don't know the future. You have to make assumptions, and it tells you exactly what price to pay based on those assumptions. Okay, so we're going to do a 10-year analysis. You can do between 1 and 20. We're going to do a 10-year analysis on Bristol Myers. Now, revenue growth. Mo?
Well,
straight.
A lot of this one is acquisitions. So.
Well, we don't want to factor in acquisitions here, I don't think.
I know. 4, 6, 8.
Okay, let's start with that. Profit margin.
5, 6, 7. I don't think it's completely unreasonable.
Here's the problem with that. It's,
4, 5, 6. I don't know. It's not. I
think higher, because they had those big write-offs a couple times. I would focus more on the free cash flow here, because look at their free cash flow margin over the last 5 years, over the last 10 years. This is where the driver is here.
Okay.
Yeah, that's great.
Yeah. So actually,
what would you put for profit margin?
Let's go back to this. Let's go back to everything money. I'm going to go look at the financials of this company. Oh, whoops, not that one. BMY, not BMI. Okay, so let's look at their income statement. How many times do they have big write-offs here? Okay, net income. No, they didn't in previous years. Their profit margin in previous years was 20%. Yeah, Mo, I think I'm going to go with...
Higher?
Yeah, I think I'm going to match the... I think I'm going to do profit and free cash flow. I think they just had these big write-offs in the last few years, and that's what affected it. I don't think we should factor that going forward.
I see what you're saying. Okay, this makes sense. So basically, yeah, now you're right, because you're factoring out acquisitions.
So 2022-24, how about that?
I made the mistake of not doing that. Yep.
How about 2022-24?
Sure.
What about PE?
Well, they're a very large drug company. What's their current PE, Seth?
Well, they didn't make money last year, so trailing 12 months is not. But the 5 year is 100.
Okay.
I don't think it matters what it currently is.
14,
what matters
16,
is what we
18.
think. What was that?
14, 16, 18.
Let's do it. And same with free cash flow, I assume. Okay, guys. Now, desired return 12.5%. Like I always say, you can invest in an ETF and get 9 or 10%. So to make it worth your while to buy an individual company, get a higher return, hit the analyze button. Wow.
I'm thinking there'd be some green there.
Guys, even the lowest price is 53. It's at $54 currently. Middle price is 72. High price is 97. So what does this mean, guys? This means that if you believe these assumptions above, you're buying the stock today.
These are pretty conservative assumptions, wouldn't you think? I mean,
yeah,
lower PE.
4%. I mean, it does make sense. And this might be one of those things that's been affected because of that, for the write-offs affecting the PE. Mm-hmm. This might make sense. Mo, do you own any Bristol Myers?
Yeah.
Do you? Mm-hmm. Excellent.
Straight up or options?
Straight up.
I don't own any Bristol Myers. But I like companies that show massive losses, even though they're just book write-off losses, in a way, because it tends to tell the market. The market will be like, oh my God, it lost money. There's no PE. Let's avoid it. Okay, sounds good.
If looking at these numbers resonates with you and you're drawn to this, Paul will tell you right now how to get this software.
All right, thanks, Seth. So guys, we created the software because our users kept requesting, how do we do our own research without waiting for you to make your own videos? So we spent lots of money, created the software. You get everything you already saw in the video. You get all of this content right here, which includes 30 years of financial data, access to Seth, Mo, and I. You get it all on your mobile phone. This entire website, everything you've seen on your mobile phone. You get the stock analyzer tool. You get real estate calculator, retirement calculator, all the extra additions. You get our 8-pillar portfolio, exclusive daily content, 2 or 3 videos a day from Seth, Mo, and I on separate topics. But most importantly, guys, you get access to over 6,000 people are current active users of our software. They're in a chat that's very organized with multiple rooms about different topics. You can talk to them about all your investment ideas, tell them your ideas. They give you feedback. You have actual discussions, because most of the people are like you out there who didn't have others to talk to about investing. Now you do. This is wonderful. It's only 90 cents per day. Less than a cup of coffee, guys. 90 cents a day. If you can increase your returns by 1 or 2% a year, or decrease your losses by 1 or 2% a year, this will lead to hundreds of thousands, if not millions of dollars in extra wealth when you retire. 90 cents a day, guys. 2 ways to sign up. everythingmoney.com or Patreon. The benefit of everythingmoney.com is you get no sales tax charged to you yet because we're not big enough. So sign up, you get access within minutes, 90 cents per day.
And if you're interested in trading Bristol Myers, Mo, show us the charts and what you're doing with the people in the Bidnas Nation and how they can make money on these swings.
So guys, this is a long-term chart, and the first thing I like to do is zoom out like this and kind of see where our support level is, especially with a fall like we've had over the couple months. Let's go back and just see. So we have some consolidation in here, which was right around COVID. You have a couple of tops that fell out right here. So right now, we're kind of sitting at that, a pretty good resistance point, as you can see. I mean, support level, as you can see. So what I would do is just pay attention down here to this long-term stochastic, and maybe throw a tracker share on this. This will probably go sideways for a little bit, then it'll pop up into the sweet spot, and that's when we'll be able to capitalize and move this thing to 60, and maybe beyond 60. Who knows? Because there's this fall that happened. It happened relatively quickly. So that means that there's not a lot of these M formations in there. So that means that there's not a lot of resistance points in there. This is good news for you if you're a trader. So this, to me, is something that you should put on your watch list. Now, why don't we go to a 15-minute chart? When you have days where, like yesterday, when you drop 4% or something, and you see on Yahoo Finance or whatever that these are the top movers of the day, pay attention to them. You can come over here, and you could have shorted this the entire day. Jumped in there at 10 o'clock and ran it until about 12:15, and you could have caught this entire way down. That was a 4%, 3% gain, whatever, depending on your entry point. So there's different ways that you can approach this, but for me, I would put this on my long-term watch list, even throw a tracker share on it, $54. Worst case, Bristol Myers goes away, they're not in existence anymore, and you lose $54. So if you want to learn these rules, come and join me in the Bidnas Nation. You'll get access to the Trading 101 series, which is all the rules that I'm talking about, the Employed Trader series, which is 6 stocks that we follow long-term and swing trade on a daily basis, exclusive monthly seminars, which I am going to be doing one this coming Saturday, and the Bidnas Discord community of 900 plus people that all want to trade just like you. Come and join us.
Paul, final take on Bristol.
I just worry about the debt. To me, the debt's the issue here. It's if we look at our 8 pillars tab, that debt level, actually, it wasn't as bad as I thought. No, actually, I'm not worried about the debt. Forget it.
Okay, and as Andy, you were going to say it, we would, if it was me and we were worried about the debt, I would go see, hey, is this something that's consistent in the industry?
Well, the other thing is, though, the debt levels were based on a lower free cash flow because of before the acquisitions. Yeah. Now the free cash flow is a lot higher. Right. Remember, the free cash flow is now like $14 billion because they made 2 big acquisitions, but the average is 8.4 because it's been 5 years. So I'm not worried about the debt. I'm looking at Bristol and probably looking at going, hey, I think I'm probably going to look at this thing because, I mean, I'll probably talk to my father. My father's a physician, and Mo's father's a physician, and say, hey, what do you think of this pipeline? What do you think of the company? And go from there.
Any further things you would do for our viewers at home in terms of due diligence before buying this?
Yes. Go read that 10K. Go understand. Go join our software. You can talk to over 6,000 people in our community that can discuss the software with you.
There's physicians in there that can talk to you about these drugs too.
That's our take. Incredible company. We'll keep you updated. Great video, Paul. You were on fire today. Fondle thumbs up. Watch more videos. We'll see you in the next one.